Friends, thank you. Happy New Year. Welcome to actually the first webinar that Agency One is hosting this year. And we are honored to be introducing our friends from John Hancock. We're kicking the new year off with a John Hancock webinar on indexed universal life and managed volatility segments. Our good friend Wayne Baldwin, who most of you know. Wayne has been our regional at John Hancock for, I think, since I graduated from college. There's certain things just always made, you can count on certain things, and one thing you can count on is Wayne Baldwin, and Wayne working on all of the Hancock cases and making sure everything, whatever needs to happen, happens. Wayne called us a few weeks ago and said, hey, listen, we've got this new index that we are introducing, and I've got a phenomenal partner at John Hancock by the name of Zach Barron, who is the Index UL product manager, and I would be delighted if you guys would agree to host a webinar where we could introduce the Barclays Global Managed Account Index, and Zach can explain why this index is different than other indexes and why John Hancock is the carrier that you guys should be looking at when you're looking at IUL, and how this index is going to set their product apart from everybody else's. So we said, Wayne, for you, anything, we're happy to kick the year off with you. So let me introduce Zach, and then I'm going to turn it over to him. And we don't have a lot of folks on the line, so we're happy to make this conversational. If you've got a question, just kind of let us know, and we will either try not to interrupt Zach too much, but we'll try and keep him on track and answer the questions as they are, as you guys have them. So without further ado, Zach Barron is the director for John Hancock Accumulation Product Suite. He and his team are responsible for the long-term success of John Hancock's accumulation portfolio, including the accumulation IUL, accumulation VUL, and the accumulation SVUL. Zach joined John Hancock in 2015 and has been in product management since 2018. He has led several major development projects, including the launch of the John Hancock IUL Academy site and overseeing the implementation of AG 49A. Prior to managing the accumulation suite, Zach worked on the product development team as the competition analyst and continues to use strong industry knowledge from that role to drive growth in the accumulation product lines. Hey, Zach, before I turn it over to you, Wayne, is there anything that you would like to add before we let Zach loose with this webinar? Wayne, I think you're on mute. All right, well, you know what, Wayne, we're going to come back to you at the end. So I'm going to turn it over to Zach. Zach, thank you for joining us. And we are very excited to hear what you have to say and learn a little bit more.
Yeah, thanks very much, Kathy. And thanks everyone for joining today. Happy New Year to everyone. Hopefully you had a great finish to the year, and we're really excited to kick off the year with you with the first webinar to start the new year. So yeah, I want to talk about our new indexed account on our IUL products, and really just give more of a background on, why, these managed volatility type accounts have started to, I guess, proliferate in the market, why you're seeing more of them in the industry, and really what sets ours apart. I think really the goal here is just to come away with an understanding of how these accounts work, what's going on inside these different types of indices, and really just make you feel comfortable with it. I think that's the biggest thing here is, there's definitely a lot of different flavors. It's not just the S&P accounts anymore on IUL. So really want to make sure you understand the different accounts, different indices, what exactly differentiates John Hancock, and really feel confident, making sure that what we're selling is achievable for clients, and we can really deliver those results as opposed to just selling on, an illustration. So for background, I think it's good to start with, where exactly does IUL fit? Just as a product line, really sort of understand, when we started selling indexed UL, over a decade ago now, what was the goal, right? So, with UL, obviously you have, a stated rate from a carrier, and then you also have sort of a stated minimum. So UL is sort of that, narrow range of return outcomes. Then you have VUL, which is sort of the broad range of outcomes, right? You can have unlimited upside, unlimited downside. IUL was really intended to fit sort of in that middle ground, where clients can get some additional upside potential, not as much as VUL, but more than UL. But then they also have some downside protection as well, right, with the stated floor, which is typically just 0%. So it sort of fits in that middle spectrum, where there's a moderate range of outcomes, right? In some years you could be hitting the cap, in some years you could be at the floor, but really just meant to give more upside potential than UL, but not as much risk as a VUL. Now, in practice, how does that work, right? If we go back, back to 2006, 2007, over the last 15 years or so, and just look at, how an IUL would have performed relative to just, let's say, the S&P. Right, let's say we have a 10% cap. You would have been in that very narrow range of outcomes, whereas the S&P in a lot of years would have been well above that, or if we look at 2008, it would have been well below that. So you're not getting sort of those big return years that you're getting with the S&P, where you see it's up 25, 30%, but you're also missing out on that 2008 where you're down 40%. So again, really just meant to give some upside potential and that downside protection as well. So you're not just sort of left with that year where 2008 where you just have a huge negative return, and then you have to explain that to a client. So the question becomes, how does that work with IUL? How do we actually get like a significant return? And how do the different parameters really affect that return, affect the cash value growth? So let's just look at those S&P returns again, same period of time. Again, just looking at the S&P return. And let's just say, at the start of that period, you invested $100. This isn't taking into account any of the actual policy level charges, any cost of insurance, anything like that. It's just based on the returns, and we're just looking at, if you invested $100, how would that $100 have grown over this period of time? So just with the S&P account, or sorry, just with the S&P, like if you invested in the S&P itself, you would have ended up with $325 at the end of this period. So pretty good growth. Obviously, you have that minus 40% early on, but after that, it bounces back pretty well. You have a couple good years. I think most people would say over the last decade, notwithstanding last year actually, but over the last decade, we've had pretty good returns in the market, and you've seen that here. Now, if we compare that the same period where we actually have, an IUL with a cap and a floor, right? Let's say we had a hypothetical account where it had a 0% floor and a 12% cap. If we had that, we'd actually end up with a pretty similar, cash value growth stream, right? We end up at just under $320. The issue in the current environment, and I think part of why these managed volatility accounts have started to exist, is that, by and large, there really aren't 12% caps anymore on IUL. We've seen interest rates go down. They've started to come back up a little bit now. We've seen options costs go up, which is the cost for the hedging. So what that's led to is really falling caps. So now, we've seen, if it fell to 10%, if it fell to 8%, 8% isn't really that uncommon now in the market, in that 8%, 9% range. And really the IUL value proposition has taken sort of a big hit, right? The cash value growth potential just based on falling caps has, pretty significantly deteriorated. If you're just looking at an 8% cap here, now you're only left with just under $225. Whereas the 12% cap kind of was similar to the S&P return over that same period. So falling caps definitely have impacted the ability of IUL to give sort of that upside potential, which was part of the original value proposition. So the question becomes, where does the managed volatility fit? How does it help with that solution, essentially? So really, I mentioned this on the last slide. There's sort of two things that help determine caps. And it can be caps, it could be the participation rates, any of the index account parameters, essentially. And the two things are essentially the carrier's portfolio yield, their general account yields, which sort of supports it, and that pays for any of the costs, and then the cost of options, which are essentially the cost for us going out and buying options to hedge these different accounts. Options costs are really determined by volatility, right? If the market is very volatile, the options cost will go up. And what we've seen over the last several years is that volatility has been very high, and it continues to be very high. Markets have been sort of up and down and all over the place over the last year or so. And volatility has basically been high since the pandemic started, since like 2020. So we've seen that have a lot of downward pressure on caps because the cost of options have gone up. As we started to see interest rates rise, that's helped a little bit because the portfolio yields have come up. But 2020 was sort of a perfect storm, right? Volatility was super high because of the pandemic. Interest rates cratered. They were at like 50 basis points at one point. So it was sort of a perfect storm. And that's why you saw in 2020 was like, some carriers impacted caps twice, maybe 3 times. So we've definitely seen a lot of downward pressure on caps, both because of, at the time, low interest rates and increased volatility, which raised options costs. So the way managed volatility accounts help with this is that the options costs are fixed, right? So all of these types of indexes essentially manage to a volatility target or a volatility threshold. So how that works is essentially if volatility goes up and it starts to exceed the threshold or the target on the index, they're going to start shifting among the different assets. So if volatility is high, they're going to shift you out of equities and into fixed income. And so the volatility will sort of be maintained at the index level. What that means for us as a carrier and how it helps with this problem is essentially that cost of options is fixed. So the only moving part on the parameters for these types of accounts is just the portfolio yield. And this is going to sort of lead into, I guess, the next discussion. We, John Hancock, feel as a carrier, we have a very strong general account yield. On our protection UL line, we actually raised crediting rates twice this year. So we think this is a really, really advantage for us, right? If these accounts are really just based on a portfolio yield, we feel very strongly that we can deliver sort of a strong solution for this market, and that's what we'll see in the next couple slides here. So again, how does managed volatility help with these caps, right? Now we don't have this downward pressure where options costs are putting pressure on caps and sort of driving that return down. If we just compare with our Barclays bonus account, which is based on the Barclays index, and compare that $100 invested over the same period of time, we sort of go back almost exactly to that sort of 12% cap sort of growth potential. And it's really important to point out here, the comparison on the return sort of year to year, right? You see, let's say 2008, 2009, right? The S&P is up 26%. Barclays is only up 12, 13%, right? I think in general, right, you're not going to see those huge years that you see on the S&P, right? Their managed volatility are not supposed to have those sort of big swing years. So you won't see it go up 20, 30%. But what you'll see is, I describe it as, hitting the doubles and triples, not necessarily the home runs. You'll see, high single digits, potentially low double digits. So significant growth years, still good upside potential on these accounts without that sort of downward pressure from falling caps, essentially. So just looking at it again, the comparison, right? So this is just a different visual, right? If we just show the 12% cap here, again, this is the same period of time, just showing the returns sort of year to year. And then we see the 8% cap, we sort of seen that falling, that downward pressure on returns over time. Essentially, the Barclays bonus gets us back to a very similar return profile as the 12% cap, right? It's actually very interesting just how similar the graph looks to the 12% cap line. So again, really just bringing us back to essentially the original value proposition of IUL, which is some upside potential, right? Most years you're not going to see that 20, 25% return. You're really in that sort of low double-digit range on the big up years, but still that downside protection as well with the 0% floor. So again, just getting back to that original value proposition. And really, I think that's important to note as well. It's, how does it really do this as like an index? Really, it's just about lowering that sort of annualized volatility, right? I think over time, if you were just invested in the S&P or a managed volatility index like the Barclays index, we would expect the returns to be lower on a managed volatility index, right? Like S&P has been had good returns over the last several years, but the volatility is super high. Year to year, it can swing pretty wildly, right? You see that average annualized volatility is like 21%. On the Barclays account, right, we're managing to a specific volatility. That volatility target is 7%. So we're trying to get as much return as we can for that 7% volatility. And really, we're trying to sort of maximize the returns for that specific volatility target. So it's really about improving those sort of risk-adjusted returns over time. Okay, so now just to talk about a couple things when you're looking at different indices, different managed volatility accounts, and some things to keep in mind, and really sort of how we set ourselves apart as well, and what we can offer on these products. So the biggest thing, and I mentioned this at the start, is what is called the volatility target or the volatility threshold. So for us, with John Hancock, we have the highest volatility target in the industry. It's at 7%. You saw that on the last slide. Most competitors are in the 5% range, maybe 6%. I'll talk about why that's a good thing in a second. But what that actually means is it's really the threshold before the index is going to start shifting amongst the underlying components. Right, so if the volatility exceeds the threshold, let's just say it's 5%. If the volatility exceeds 5%, the index is going to start putting you into less volatile assets. So whether that be fixed income or even in some cases cash. That's generally a bad thing, right? You don't want to have a client who's locked up in fixed income or, God forbid, cash, because then they're not going to get any return, right? So having a higher volatility target, higher volatility threshold means over time you should have a higher equity exposure and higher upside potential. Right, that threshold is really going to be sort of what sets that equity exposure. So one with a higher volatility target generally means you're going to have a higher equity exposure over time, higher upside potential. If you take nothing else away from this presentation, I think that's your 30-second elevator speech right there. Higher volatility target means higher equity exposure, means higher upside potential over time. That's the gist of it. If you have to explain it to a client, that's, I would say, what you would describe to them. So the other things that I think are important to note, though, in case they come up, and definitely exist on some of these indices. So an embedded fee, some of these indices have an embedded fee. Ours actually does, a couple of the other ones do. What that means is really a fee just specifically at the index level. So that's not at a policy level. You won't see that on an illustration. You won't see that in their annual statement. It's really at the index level. And that's sort of like a fund fee where it's a carrying cost for the different components. It's like a rebalancing cost. Really the biggest thing there is that it could lower the potential credit to clients. So if you have an account that returns 10%, but it doesn't have a fee versus one that does, the one that doesn't have a fee will return higher. Any returns we show on our illustration or on any of our marketing material are already net of that embedded fee. So it's just something to keep in mind. If a client asks about it, it is essentially just like a carrying cost for the index for the different components, but something to keep in mind if it does ever come up. The other thing I would mention is the underlying assets. So some of these different types of indices, only have like 2 or 3 assets, and it might just be like US equity and fixed income. With us, with John Hancock, we have a broad range of assets. So we have US and international equity, US and international fixed income. In general, I think that's just a better fit for trying to manage to a certain volatility level, right? Like if we are trying to diversify, it definitely helps to have different assets that we can allocate to over time. If US equity is super volatile, we can put you into international equity, so you still have some upside potential. Whereas other accounts, other indexes are very limited if you only have 2 or 3 underlying components. So just having a broader base can really help with the diversification and managing to that certain volatility threshold, essentially. So then really tying it all together, why do the volatility thresholds matter? You're going to see it really on the return potential. So these are essentially comparison over the last 15 years of a number of these accounts in the market. This is all public, right? This is all from a carrier's illustration, right? So they show these returns on an illustration. We didn't do anything crazy here. We pulled these numbers right from the carrier's illustrations. And we can see that, our average is the highest, by a lot compared to some carriers, right? Like we're 100 basis points over the nearest competitor. We're, 4% above some of our other key competitors. So really that's sort of what I was getting at on that last couple slides, right? Having a higher volatility threshold, means that you'll have higher equity exposure, higher return potential over time. You see, some other carriers, you might only get, those single digit returns in some years, whereas with us, you're getting low to mid double digits. And that's really going to have a big impact, especially over a policy where, you're buying it for a long period of time. That return potential is really meant to be over sort of a long period of time. So having that higher equity exposure can really, really benefit the client. And just to show sort of a different comparison, I don't want to pick on Nationwide, but they're a good example because they have two different accounts that have different volatility thresholds. One's at 5 and one's at 4.2. And just looking at the graphic, almost like we did with caps, right? Here's their one with 5% volatility threshold, and here's their one with 4.2, excuse me. It's really sort of striking. It's almost like the old cap comparison, right? Like they sort of track each other, but they're just lower. So sort of having that lower volatility threshold is almost like having a lower cap. That's really sort of a way to think about it with these types of accounts, because you're essentially going to have lower upside potential, just in the same way you would with a lower cap on an S&P account. And then if you compare it to ours with the 7% threshold, right, you see that higher return, year by year. So I think that's just a good comparison, and a good way to think about it is having that higher volatility threshold is in some ways similar to having a higher cap, where you have a higher upside potential in those sort of big years. So I went through that pretty quickly. That's sort of all I had, but happy to answer any questions or go over anything in a little bit more detail here.
Thank you. Thanks, Zach. I appreciate the presentation. Lisa, I'd like you to take everybody off of mute. So if anybody would like to ask any questions, we will certainly entertain them now. Wayne, I see that you are now live, and I apologize that you aren't able to say something in the beginning. So before we open this up to questions, I didn't know if you wanted to add any additional flavor to what's been presented.
Absolutely. First of all, for those that know me, you cannot keep me muted forever. I will find a way in. But thank you. No, first of all, Happy New Year, everyone. John Hancock had another great year last year from a business standpoint, and we again had a great year with Agency One. So first of all, I want to thank you for the business that you did with us. You have quality advisors, Agency One, and I think the important thing for today was I've met with a lot of you, and I understand how you dig into products. You want to understand and feel comfortable with what you're presenting to your clients, and I applaud you for that. I hate to say this, not all producers are built that way. They just kind of sell the illustration. That's not this group. I know it because I get a lot of good questions. So I just wanted to make sure that you understood our Barclays managed volatility account, not so much versus the other carriers, but understood how it worked. And I think more importantly, what stands out in this presentation from Zach is the fact of why these volatility account or managed volatility accounts have become so popular, not just popular because they're showing a higher AG 49 rate, but because of why it works and the cost of having the caps in the product. So I think that's important for you as an advisor to your clients to understand. But again, thank you. Thank you for the business that those of you who did business with us. And for those that haven't, maybe this is an opportunity. Thanks.
Thank you, Wayne. I see that Stuart has a question. Stuart, your line is open, so
thanks.
Ask away.
Yeah, great, super helpful. I think maybe you addressed this before, but this is available? This is being added to legacy contracts. We're at segment maturation for policy reviews. This will be available, so we could maybe reallocate existing matured segment cash values to this particular index strategy.
Yeah, that's a good question. That's one that's come up a couple times. We don't have that yet. I do. That's a goal of mine. I would say it would just take a project for us to do that and actually send out like enforced mailers and add endorsements to contracts. So not yet. I do want to do that at some point in the future, but we haven't gotten there quite yet, I would say.
So this is a going forward strategy, not a strategy that we can add to legacy clients.
Right, not yet. So it's on all our current products. I think hopefully at some point in the future we can add it to the Enforce as well.
Got it. Okay, thank you.
Thanks, Stuart. Does anybody else have any questions? Just Mitch, I see that you are now unmuted.
Yeah, a quick question. For illustration purposes, what are we illustrating at?
Yeah, so good question. So we typically default to our Barclays bonus account. That one's going to generally illustrate the most competitively. On our accumulation IUL, it's showing at 5.9%. On our protection IUL and protection SIUL, it's 6.34%. And that sort of, is interesting, right? So we're sort of in line with other carriers. Most carriers are in the 6% range. But I think we feel a lot more confident we'll actually be able to hit what we're illustrating, right? Because the back-tested performance is so strong. I think other carriers, right, they might have 7% back-tested performance and they're only showing like 6.6% or something. So I'd feel a lot more confident with us as opposed to being able, in regards to being able to actually hit what we're illustrating. Whereas some other carriers, right, if they underperform, they might not be able to hit that.
All right. Thank you.
Does anybody else have any other questions? Stuart, I see your hand is still up, but that might only be because we haven't lowered it.
Sorry.
That's okay. Barry?
Yes.
Happy New
Hi.
Year. Welcome to the webinar.
Thanks, Kathy. Happy New Year. Hey, Zach, when you said 5.9 is the illustrated rate, is that for any index that the client chooses to drop the first premiums in?
So that one's for the two Barclays accounts. I want to say the 2-year account is that. The other accounts will have different max rates, but the Barclays accounts are both at the 5.9.
So you'd have to indicate that when asking for an illustration, you'd have to say, show me a Barclays account illustration, or what you're illustrating at.
Yeah, so you would, I mean, if you're running an illustration, you have to specify what index account you're using. But yeah, it would default to Barclays and it would default to a 5.9, but you could certainly run it in different accounts or different rates.
No, good. Got it. Thanks.
So Barry, you bring up a really good point. We've got Ed Stark on the line, and as you know, Ed oversees case design and illustrations.
Yep.
Ed is familiar with the product and the account, and if you've got specific metrics that you would like to see input into the illustration, that's certainly something Ed can do for you and is happy to do so as well.
Got it. Thanks, Cal.
You're welcome. We are just coming up on 3:30, so I want to be mindful of everybody's time. Does anybody else have any questions while we have, the architect, the expert? We don't often have the opportunity to interact directly with, the person who's responsible for, putting forth the products and really can break down these products into the ingredients that's used to deliver something to your client. So, you can limit this to Barclays or, Zach, I'm going to go out on a limb. If you've got questions about anything else regarding John Hancock and their IUL products, Zach would be happy to address those questions as well.
I have one more question, Kathy.
Sure.
Hey, Zach, I just got a notice from Athene saying that their Barclays account, and don't know if it's the same, their Volatility Barclays account last year turned 3.5%, something like that. Is that what your account turned also?
No, so that's a different index. They do, Barclays does one for Athene on, I believe, their fixed index annuities.
Yeah.
So this one is a different one. This is like proprietary to us. Ours was, it was 0% for last year. Most were actually Barclays. Their FIA one is one of the few that was positive.
Yeah.
And it's just structured a little bit differently. But yeah, it's so I'll guess I give a plug for Barclays. They're pretty much the largest hedge provider in the indexed annuity space. They're very good at it. And I think they just have a strong track record as an index provider.
Well, let me ask you something, Zach. What, eking out a 3.5% return last year, someone would say, hey, that's pretty good. What would you say to somebody who said, you put me in a volatility account and I still made zero? I would think the expectation is that the volatility account in some way would try and balance out these scales while the scales were tipping.
Yeah, it's a good question. So like, so what I would say to that is last year was sort of a weird year where, fixed income was down because interest rates sort of shot up as quickly as they did, and equities were also down. So basically the two components that make up most managed volatility accounts were down. So most of these accounts were at zero. The S&P, if you were an S&P account, you were also at zero because equities were down.
Right.
Where I would position this, especially for us, is I think we can capture the most of that upswing if markets come back up because we should have the most equity exposure. So, right, like on most of these types of accounts right now, most of them are in fixed income or cash. So if, let's say, markets start going gangbusters and take off again this year, most of these types of indexes are going to get stuck in the fixed income and cash and not really be able to capture that. We actually, I think, would because we have a higher equity exposure. We actually have a minimum equity exposure. And we saw that we had like some backtested performance in 2020 is a great example of that, where, when the pandemic hit, markets really cratered, but then it was sort of a V-shaped recovery. It took off really quickly.
Right.
And it wasn't live then, but we actually would have credited like 7% over that period. And most of these accounts would have been down. So I think that's our talking point. I don't know what the market's going to do this year, but if it does take off, I think we feel very confident on what we can offer.
We're just always scratching around for talking points. That's all. So thank you.
Now, Zach, the minimum equity exposure is 25%. Am I correct there?
Correct, exactly. So we would have at least 25% exposure to equities with this index.
Right.
Sure.
So that speaks to what you were talking about.
Stuart, the floor is yours. Hold on, let's take you off of mute.
One last question.
There you go.
Can this presentation get circulated by chance, just so we have it, or is that?
Yeah, it's compliance approved. It's on our like IUL Academy website, but yeah, I can send that over for sure.
Thanks, Zach.
Yeah, so we will make this available after the webinar. The webinar has been recorded, and Lisa can distribute the materials to those that have that are on the call. So we'll get that out afterwards. Does anybody else have any other questions? I will take that as a no. Well, on behalf of Agency One, thank you for joining us. We value our relationships with you. We look forward to a prosperous and healthy 2023. We hope to work with you to increase your production at least one case, $1 over what you accomplished in 2022. So, let's try and aspire for that for everybody on the phone. And if we can be of any service, if we have anything that you would like to discuss with us, please give Gonzalo, myself, Ed Stark, Dennis a call. We are happy to assist in any way, shape, or form, and we do not take you for granted. And we hope everybody has a happy and a healthy new year, and we look forward to working with you throughout the year. Thank you. Thank you to
everyone.
John Hancock,
Thank you.
Zach,
Thank you
and
all.
Wayne.
Thank you.
Take
Yep.
care.
Thanks, guys.
Bye.